हेलो इग्नू पॉइंट्स, कैसे हैं आप सब। आई होप आप सब अच्छे होंगे। सो वी आर बैक विद अनदर एक्सप्लेनेशन वीडियो। तो आज का हमारा असाइनमेंट है MMPC 004 अकाउंटिंग फॉर मैनेजर। सो देयर आर 5 क्वेश्चन। ओके, सो लेट्स गेट स्टार्टेड। ड्यूरिंग assignment course code MMPC 04, course title accounting for manager, assignment code MMPC 004, TMA July 2023. So during the current year, AV Limited should profit of rupees 1,80,000 on a sale of rupees 30 lakh. The various expenses were 21 lakh. You were required to calculate. Okay, the break-even sales as present. The break-even sale if variable cost increased by 55.3. The break-even sales to maintain the profit as at present if the selling price is reduced by 6%. To calculate the break-even sales in which of the following scenarios we need to understand the components of the break-even analysis. Break-even analysis is a financial tool used to determine the level of sales at which a company's total revenue equals its total cost, resulting in zero profit. It helps a company identify the level of sales needed to cover all the expenses and start generating profits. The formula for calculating break-even sales is equals to fixed cost slash selling price per unit minus variable cost per unit, where fixed cost is a total fixed cost incurred by the company which do not vary with the level of production or sales. Selling price per unit, the price at which each unit of the product is sold. Various cost per unit, the cost incurred per unit of product which varies with the level of production or sales. Given data, profit on sales is rupees of 1,80,000, selling prices of 30 lakh, and the various expenses of 21 lakh. Let's calculate the break-even sales in each scenario. First, the break-even sales at present. In this scenario, we will consider the current situation where profit on sale is of rupees 1,80,000. Solution. Step 1, calculate the total fixed cost. Then we calculate the total fixed cost equals to various expenses plus profit on sale. Total fixed cost is 21 lakh plus rupees 1,80,000 equals to 22 lakh 80,000. Calculate the in step 2, calculate the break-even sales. Break-even sales is equals to total fixed cost slash selling price per unit minus variable cost per unit. So break-even sales is equals to 22 lakh 80,000 slash 80 lakh minus variable cost per unit. We do not have the value of the variable cost per unit, therefore we cannot determine the exact break-even sales in the current scenario without this information. And second, the break-even sales if variable cost increased by 55%. In this scenario, we will assume that the variable cost per unit is increased by 55%. Solution. Step 1, calculate the increased variable cost per unit. Increased variable cost per unit is equals to current variable cost per unit plus 55% of current variable cost per unit. Increased variable cost per unit is equals to current variable cost per unit plus 0.55 current variable cost per unit. Step 2, calculate the new break-even sales. New break-even sales is equals to total fixed cost slash selling price per unit minus increased variable cost per unit. New break-even sales is 22 lakh 80,000 slash 30 lakh increased by variable cost per unit. Again, we do not have the value of the current variable cost per unit, so we cannot determine the exact new break-even sales without this information. The break-even sales to maintain the profit as at present if the selling price is reduced by 6%. In this scenario, we will consider the current situation with the selling price reduced by 6%. Solution. Step 1, calculate the reduced selling price per unit. Reduced selling price per unit is equals to current selling price per unit minus 6% of current selling price per unit. Reduced selling price per unit is equals to current selling price per unit minus 0.06 into current selling price per unit. Step 2. Calculate the break-even sales with the reduced selling price. Break-even sale reduce equals to total fixed cost slash reduced selling price per unit minus variable cost per unit. Break-even sale reduce equals to 22,80,000 slash reduced selling price per unit variable cost per unit. Similarly, we do not have the value of the current variable cost per unit, so we cannot determine the exact break-even sales in the scenario without this information. In conclusion, without the specific value of the variable cost per unit, we cannot calculate the break-even sales in any of the given scenarios. The variable cost per unit is essential to determine the break-even sales, and its value is not provided in the given data. Next question. XYZ Limited is currently working at 50% capacity and produce 10,000 units. At 60% capacity, raw material cost increase by 2% and selling price fall by 2%. At 8% capacity, raw material cost increase by 5% and selling price falls by 5%. At 50% capacity, the product costs rupees 180 per unit and is sold at 200 rupees per unit. This unit cost of 180 comprises the following: particular material 100 rupees, wages 30, factory overheads 30, which is 40% fixed, and administrative overheads, which is 20 or 50% fixed. Prepare marginal cost statement showing the estimated profit of the business when it is operating at 60 and 80% of the capacity. To prepare a marginal cost statement and estimate the profit of the business at 60% and 80% of capacity, we need to calculate the variable cost and total cost at each level of capacity utilization. The given unit cost of rupees 180 includes material, wages, and variable factory overheads. The fixed factory overheads and administrative overhead need to be added separately to arrive at the total cost. Let's calculate the marginal cost statement for both scenarios. Given data is current capacity 50%, production at 50% capacity, which is 10,000 units, production at 60% capacity, which is 60% of 10,000 units, equals to 6,000 units. Production at 80% capacity, 80% of 10,000 units, equals to 8,000 units. Selling price per unit at 50% capacity, which is 200. Marginal cost statement at 60% capacity. Step 1. Calculate variable cost per unit. Variable cost per unit equals to material cost per unit plus wages per unit, variable factory overheads per unit. Variable cost per unit is 100 plus 30 equals to 160. Step 2. Calculate the increased material cost at 60% capacity. Increased material cost at 60% capacity is equals to material cost per unit at 60% capacity minus material cost per unit at 50% capacity. Increased material cost at 60% capacity is equals to 100 plus 2% of 100 minus 100. Increased material cost at 60% capacity is 100 plus 2 minus 100 equals to 2. Calculate the reduced selling price at 60% capacity. Reduced selling price at 60% capacity is selling price per unit at 50% capacity minus 2% of selling price per unit at 50% capacity. Reduced selling price at 60% capacity is equals to 200 minus 2% of 200. Reduced selling price at 60% capacity is 200 minus 4, which is equals to 196. Calculate the marginal cost per unit at 60% capacity. Marginal cost per unit at 60% capacity is variable cost per unit plus increased material cost at 60% capacity. Marginal cost per unit at 60% capacity is equals to 160 plus 2 equals to 162. Step 5. Prepare the marginal cost statement at 60% capacity. Marginal cost statement at 80% capacity. Step 1. Calculate variable cost per unit. Variable cost per unit is material cost per unit plus wages per unit plus variable factory overheads per unit. Variable cost per unit is 100 plus 30 equals to 160. Step 2. Calculate the increased material cost at 80% capacity. Increased material cost at 80% capacity equals to material cost per unit at 80% capacity minus material cost per unit at 50% capacity. Increased material cost at 80% capacity is equals to 100 plus 5% of 100 minus 100. Increased material cost at 80% capacity is 500 plus 5 minus 100 equals to 5. Step 3. Calculate the reduced selling price at 80% capacity. Step 4, calculate the marginal cost per unit at 80% capacity. Step 5, prepare the marginal cost statement at 80% capacity. In conclusion, the estimated profit of the business at 60% capacity utilization is of rupees 1,90,800 and at 80% capacity utilization is of rupees 1,82,400. The marginal cost statement shows the contribution to profit after covering variable cost and the estimated profit after deducting fixed factory overheads and administrative overhead. The profit decreases as capacity increases due to increase material cost and reduced selling price. Explain the following. Business entity concept. The business entity concept is one of the fundamental accounting principles that guides the recording and reporting of financial information of a business. It is based on the assumption that a business organization is separate and distinct from its owner or shareholders. According to this concept, the financial transaction and activities of the business are recorded and reported independently from those of its owner or any other entities. Key feature of the business entity concepts: separate legal entity, accounting record, financial reporting, capital and financing, limited liability, consistency and comparability. Importance of the business entity concept: accurate financial reporting, transparency and accountability, legal compliance, investor confidence. Limitation of the business entity concepts: related party transactions, small and medium sized enterprises. In conclusion, the business entity concept is a fundamental accounting principle that treats the business as a separate legal entity from its owner. This concept ensures accurate financial reporting, promotes transparency, and enhances investor confidence in the financially information provided by the business. It serves as a basis for preparing reliable finance statement and making informed business decisions. Accrual concept. The accrual concept, also known as the accrual basis of accounting, it's fundamental accounting principle that governs the recognition of revenue and expenses in financial statement. It requires that revenue and expenses be recorded when they are earned or incurred, irrespective of the actual receipt or payment of cash. In other words, transactions are recorded based on their economic substance and not merely on the cash flow associated with them. Key feature of the accrual concept: revenue recognition, expense recognition, matching principle, accrual and deferrals, accurate financial reporting. Example of the accrual concept: removal recognition, expense recognition, accruals, deferrals. Importance of the accrual concept: timely recognition. The accrual concept ensures that the revenue and expenses are recognized in the appropriate accounting period, providing timely and relevant financial information. Accurate financial statement: by matching revenues and expenses to the period in when they occur, financial statement present a more accurate picture of the company's financial performance and position. Decision making: accurate accounting helps stakeholders make informed decision based on the economic reality of the business rather than cash flow timing. Limitation of the accrual concept: complexity. Accrual accounting can be more complex and require careful estimation and judgment, especially for long-term contract or certain transaction. Liquidity assessment. In conclusion, the accrual concept is a fundamental accounting principle that ensures revenue and expenses are recognized when they are earned or incurred, regardless of cash flow timing. The principle is essential for providing accurate and relevant financial information, facilitating informed decision making, and presenting a more comprehensive view of company's financial performance and position. Dual aspect of concept. The dual aspect concept is also known as dual aspect principle or double entry system. Is a fundamental accounting principle that forms the basis of the accounting process. It states that every business transaction has two aspects, a debit and a credit, and the total of debits must always equal the total of credits. This concept is an essential part of the double entry accounting system, which is widely used in recording financial transactions. Key feature of the dual aspect concept: double entry system, equal and opposite entities, accounting equation, comprehensive recording, error detection. Example of the dual aspect concept is the purchase of inventory. When a business purchases inventory for cash, the inventory account is debit and the cash account is credit. Revenue from sales. When a business makes a sale and receives cash, the cash account is debit and the revenue account is credit. Payment of expenses. When a business pays expenses, the expense account is debited and the cash account is credit. Importance of the dual aspect concept: accuracy and reliability, financial reporting, error prevention and detection. Limitation of the dual aspect concept: complexity, understanding required. In conclusion, the dual aspect concept is a fundamental accounting principle that forms the basis of the double entry accounting system. It ensures accuracy, reliability, and completeness in recording financial transaction by requiring each transaction to have two equal and opposite entities. This concept is vital for maintaining the accounting equation balance and providing comprehensive financial information for decision making and financial reporting. Cash and cash equivalents. Cash and cash equivalents are important components of a company's balance sheet and financial statement. This represent highly liquid assets that can be readily converted into cash within a short period, typically within 3 months. Cash and cash equivalents are critical for a company's day-to-day operation and serve as a measure for its short-term financial strength and liquidity. Components of cash and cash equivalents. Cash. This includes physical currency such as coin and notes held by the company and available for immediate use in transaction. Cash equivalents. Common example of cash equivalents include treasury bills, certificates of deposit with maturities of 3 months or less, money market funds, commercial papers. Important of cash and cash equivalents: liquidity management, emergency funds, investment opportunities, creditor confidence. Disclosure of cash and cash equivalents. Cash and cash equivalents are typically reported on a company's balance sheet under the current assets section. They are generally listed separately from other current assets to highlight their liquidity and importance. In financial statement, cash and cash equivalents are disclosed in the statement of cash flows, which shows the sources and uses of cash during a specific period. The statement of cash flows categorize such cash flows into three main activities: operating activities, investing activities, and financing activities. Limitation of cash and cash equivalents. While cash and cash equivalents are essential for a company's financial health, relying solely on this liquidity measure may not provide a complete picture of a company's overall financial position. Some limitation includes short-term focus, inflation risk, cash holding cost. In conclusion, cash and cash equivalents are highly liquid assets that are crucial for a company's short-term liquidity management and financial stability. They provide the companies with the ability to meet its day-to-day financial obligations, respond to unforeseen events, and take advantage of investment opportunities. However, it is essential to consider a company's overall financial position and long-term strategies, as cash and cash equivalents have their limitation as a sole measure of financial health. Explain the various financial statements which are parts of the annual report. How can notes to the accounts help in better understanding of financial statement? Financial statement and overview. And financial statement are formal records that provides a summary of a company's financial activities and performance. They are essential tools for communicating a company's financial position and a result of operation to various stakeholders, including investors, creditors, regulators, and management. These are three primary financial statements that are commonly included in company's annual report: balance sheet, income statement, cash flow statement. Parts of the annual report. The annual report is a comprehensive document that contains various sections including financial statement, management's discussion and analysis, auditor's report, note to the financial statement, corporate governance and management, business overview, financial highlights, letter to shareholders, social responsibility and sustainability. Importance of note of the accounts. The note to the accounts are a crucial part of the financial statement as they provide detailed explanation, clarification, and additional context to the information presented in the main financial statements. Here's how notes to the account can help in better understanding for an financial statement: accounting policies, contingent liabilities, significant accounting estimates, segment reporting, related party transaction, leases and commitments, revenue recognition policies, impairment of assets, income tax. The note disclose detail of income tax, including deferred tax assets and liabilities, and on and any tax related adjustment impacting the financial statement. Financial instrument conclusion. Financial statement are vital tools for stakeholder to assess a company's financial performance and position. The annual report includes a balance sheet, income statement, cash flow statement, and various other sections, providing a comprehensive view of the company's operation and financial health. Among these, the note to the account play a critical role in enhancing the transparency and understanding to the financial statement. They provide detailed explanation, accounting policies, contingent liabilities, and other relevant information that aid in making informed decision and assessing the company's financial condition. Overall, the combination of financial statement and accompanying notes forms a powerful set of resources for investor, creditors, and other stakeholders to evaluate a company's financial standing and future prospects. What is human resource accounting and how it is used as management decision tool? Human resource accounting is a specialized branch of accounting that focuses on quantifying and reporting the value of a company's human resources or employees. It is based on the recognition and employees and their skills, knowledge, and experience are valuable assets that contribute significantly to a company's success. HRA aims to measure the report these human assets on the company's financial statement, allowing management to make informed decisions regarding human resource allocation, development, and overall workforce management. Objectives of human resource accounting: evaluating human capital, decision making, resource allocations, performance evaluation, investor relation. Method of human resource accounting. These are various methods used for human resource accounting, and each method has its advantage and limitations. Some of the common methods include cost based methods, value based methods, monetary units, qualitative measures. Qualitative measure helps in understanding the intangible aspect of human resource that contributes to the company's success. Uses of human resources accounting as a management decision tool: workforce planning, talent acquisition, training and development, performance evaluation, retention strategies, investment decision, mergers and acquisitions, risk management. Challenges and limitation of human resources accounting. Subjective. Measuring the value of human capital involves a certain degree of subjective as it relies as assumption and estimates. Lack of standardization. There is no universally accepted accounting standard for human resource accounting, leading to variation in method practices. Intangible nature of human capital. The value of human capital often involves intangible factors that are challenging to quantify in mandatory terms. Resistant to change. Implementing HRA may face resistance from employees who may feel uncomfortable being viewed as assessed in financial terms. Data availability and accuracy. Gathering accurate data on the cost and contribution of human resources can be challenging, especially in large organizations with complex structure. Conclusion: human resources accounting is a management decision tool that aims to quantify the value of human capital and provide valuable information to support workforce planning, talent management, and overall human resources strategies. It allows management to make informed decisions regarding resource allocation, training and development, and requirement, ultimately contributing to the company's overall success and competitiveness. While HRA has its challenges and limitations, it remains a valuable tool for understanding and maximizing the value of human resources in organization. As the importance of human capital continue to grow in the knowledge economy, the role of human resources accounting become even more critical in guiding strategic decision and fostering sustainable business access. तो यहाँ हमारा असाइनमेंट ख़त्म होता है. इफ़ यू हैव एनी क्वेरी तो आप हमारे व्हाट्सएप पे कांटेक्ट कर सकते हैं. इसका अगर आपको PDF भी चाहिए हो तो हमारे व्हाट्सएप पे कांटेक्ट कर सकते हैं. इसके अलावा MMPC 3 और 2 के भी असाइनमेंट सॉल्व असाइनमेंट हमारे चैनल पे है. थैंक यू.